If you hold silver, or if you have even a passing interest in how real assets behave in a world of financial abstraction, you need to pay attention to something subtle that has changed recently, not on a price chart, not in a headline, not in the daily noise of macro commentary. Something changed in a place most people do not look, and that is usually where the most important shifts begin. On the surface, the silver market looks almost boring. Prices drift. Volatility is contained. Commentators argue about rates, the dollar, and whether commodities are fashionable this quarter. Algorithms trade the same ranges they have traded for months. If you stop there, nothing feels urgent. Nothing feels stressed. Nothing feels different. But beneath that calm surface, a divergence has been quietly widening. And history suggests markets do not ignore this kind of divergence forever. What is unusual right now is not that silver is volatile. Silver is always volatile. What is unusual is that physical silver availability is starting to behave as if the system is under pressure, while paper prices continue to behave as if nothing is wrong. Those two things normally move together, or at least acknowledge each other. Right now, they are not even having the same conversation. Over the past several weeks, reports from refiners, wholesalers, and industrial procurement channels have started to sound subtly different. Longer delivery times, thinner spot inventories, rising premiums for immediate physical supply. Not for collectibles or novelty products, but for standard bars, industrial-grade silver, and wholesale quantities that normally move with very little friction. Yet friction is exactly what is starting to appear. At the same time, futures markets continue to price silver as if supply is comfortably elastic. Open interest remains high. Liquidity appears normal. Spreads do not signal panic. To most observers, this still looks like a market doing ordinary things. But when physical tightness increases while paper confidence remains high, it usually means something is being mispriced somewhere in the system. One explanation is timing. Paper markets react instantly. Physical markets react with delay. Contracts can be created or closed with a keystroke. Metal cannot. It has to be mined, refined, shipped, insured, and delivered. That lag can hide stress longer than people expect. By the time paper markets notice, the physical reality has often already changed. Another explanation is structural, and this one matters more. Over the past decade, silver's role has quietly shifted. It is no longer primarily a monetary curiosity or a hedge people talk about in theory. It is now a critical industrial input. Solar panels, electrification, advanced electronics, medical technology, and energy infrastructure all compete for the same finite pool of metal. Unlike gold, most silver is consumed. It does not neatly return to vaults. It disappears into products that are often uneconomical to recycle. Public data already shows that industrial demand is absorbing a growing share of annual silver supply. Mine output, meanwhile, has struggled to grow meaningfully. New discoveries are rarer. Permitting timelines are longer, and silver is often produced as a byproduct of other metals, which means supply cannot respond quickly even if prices rise. That alone creates a fragile balance before investment demand even enters the picture. What makes this more sensitive is the role of inventories. Inventories are the buffer between supply and demand. When inventories are ample, shortages remain theoretical. When inventories thin out, even small disruptions start to matter. Recent reports from major exchanges and vaulting systems suggest that while total headline stocks may still look large, the amount actually available for immediate delivery is much smaller than it appears. This is not necessarily because anyone is hiding anything. It is because the system is layered. Some metal is pledged, some is allocated, some is technically present but practically unavailable. Paper claims can multiply without requiring immediate physical backing, as long as confidence remains high and delivery requests remain manageable. That structure works until, for any reason, physical demand becomes persistent enough to stress it, and physical demand does not need to explode to matter. It only needs to be steady. A slow drain is often more dangerous than a sudden spike because it looks manageable right up until it is not. Industrial users do not speculate. They plan. If lead times extend, they secure supply earlier. If they sense uncertainty, they hold more inventory. Individually, these decisions look rational and small. Collectively, they tighten the market quietly. Now add the macro environment. Central banks remain cautious. Debt levels remain historically high. Supply chains remain fragile. Silver production is geographically concentrated, and refining capacity is not infinitely flexible. Even a logistical disruption can ripple through availability faster than futures markets usually price in. What this suggests is not an imminent crisis, but a growing mismatch between how silver is priced and how silver is accessed. Price reflects marginal trades in paper markets. Availability reflects real-world constraints. Those two can diverge for a while, but they rarely diverge indefinitely. There's also a psychological element that markets consistently underestimate. When prices do not respond to tightening conditions, participants assume the signals are false. They assume shortages are anecdotal. They assume substitutes will appear. They assume demand will soften. Sometimes they are right. Sometimes they are simply slow to update their assumptions. Silver has a long history of behaving like a normal commodity, until it suddenly does not. It sits at the intersection of finance and industry, and transitions in that kind of market rarely announce themselves cleanly. One detail that deserves more attention is the behavior of premiums. When physical premiums rise, while spot prices stagnate, it means buyers are willing to pay more than the quoted market price to secure immediate delivery. That does not automatically mean prices are wrong, but it does mean the reference price is becoming less representative of real transactions. If these conditions persist, one of two things eventually happens. Either physical tightness eases or paper markets adjust. At this stage, neither outcome is guaranteed, and that uncertainty is precisely the point. There is no single dramatic trigger here. No obvious shock, no headline crisis, just a quiet accumulation of small pressures. Markets are very good at pricing stories. They are much worse at pricing slow structural change. Right now, silver seems caught between those two forces. The story says stability, the structure suggests tension, and those two rarely remain separated forever. To understand why the current divergence in silver matters, you have to look at how the paper silver market actually works in practice, not in theory, and not in the simplified version most people carry around in their heads. Futures markets are often described as delivery mechanisms, but in reality, they function primarily as systems for risk transfer and price discovery. The overwhelming majority of contracts never result in physical settlement. They are opened, offset, rolled forward, or cash settled long before any metal needs to move. That is not a flaw. It is the design. It allows producers, consumers, and financial participants to hedge efficiently. But it also means that the link between paper volume and physical metal is much looser than most people intuitively assume. A large open interest number does not mean a large pile of silver is sitting somewhere waiting to be claimed. It means a large number of financial promises exist, most of which are structured around the assumption that they will never be tested through delivery. Under normal conditions, that assumption holds. Only a small percentage of longs stand for delivery, and exchanges maintain enough registered inventory to meet those expectations. The entire system is built around predictability. As long as behavior stays within historical ranges, everything looks stable. The tension appears when behavior starts to shift, even slightly. If a somewhat higher percentage of participants decide to convert paper exposure into physical claims, the math changes quickly. Not because the numbers are fraudulent or hidden, but because they were never meant to be stressed in that way. Think of it less like a vault and more like a traffic system. It works perfectly until too many people try to use the same exit at the same time. What makes the current environment interesting is that there is no obvious speculative rush to demand delivery. Prices are not exploding. Headlines are not screaming shortage. And yet physical availability is tightening anyway. That suggests the pressure is not coming from short-term traders, but from end users and long-term holders who operate on very different timelines. Industrial buyers do not care about daily charts. They care about continuity of supply. If they sense even a small risk of disruption, they do not wait for confirmation from futures prices. They quietly secure inventory. And once that inventory leaves the visible system, it does not come back quickly, if at all. At the same time, investment demand for physical silver tends to behave in a counterintuitive way. It often increases when prices feel boring rather than exciting. When volatility is low and sentiment is apathetic, long-term accumulators step in. They're not chasing momentum, they're exploiting complacency. Individually, those purchases look insignificant. Collectively, they can be anything but. Now add another layer that rarely gets discussed clearly. The difference between reported inventories and accessible inventories. Public data usually aggregates metal across multiple categories, ownership structures, and eligibility statuses. Some silver is earmarked for specific contracts. Some is pledged as collateral. Some is technically present but practically immobile because of logistical, legal, or financial constraints. So when people see a headline inventory number and conclude there's plenty of silver, they are often looking at a gross figure that obscures net availability. This does not mean the data is misleading. It means interpretation matters. Availability is not just about quantity, it is about willingness and ability to deliver at prevailing prices. This is where pricing signals can become distorted. Futures prices reflect marginal trades between buyers and sellers of contracts, not necessarily the marginal cost of sourcing immediate physical metal. In theory, arbitrage should close that gap. In practice, arbitrage depends on frictionless movement of metal, capital, and credit. In the real world, frictions are everywhere. Transportation costs, insurance, financing rates, refinery capacity, and regulatory requirements all introduce delays and costs. When margins are thin, arbitrage becomes unattractive. When uncertainty rises, participants become cautious. The result is that price discrepancies can persist far longer than textbook models suggest. Another subtle factor is the role of leasing and lending in the silver market. Silver, like gold, is often lent into the market to facilitate liquidity. That metal still appears in inventory statistics, even though it has effectively been promised elsewhere. Again, this is standard practice, not a conspiracy. But it does mean the same ounce can serve multiple functions simultaneously, as long as no one insists on physical separation. Confidence is the lubricant that makes that system work. And confidence does not vanish overnight. It erodes gradually, usually in response to repeated small inconsistencies rather than one dramatic failure. What we are seeing now could simply be a temporary imbalance. Maybe industrial demand cools, maybe recycling increases, maybe new supply comes online faster than expected. All of those are plausible. But what makes this moment worth watching is that paper markets are not pricing any of those risks, and they are not pricing the opposite risks either. They are pricing continuity. Continuity assumes that tomorrow looks a lot like yesterday. That assumption can hold for a very long time. It is also the assumption that breaks first when structural change is underway. There's also a macro overlay that complicates everything. Monetary policy remains restrictive by historical standards, while debt levels remain high. Governments talk about discipline, but deficits persist. In that environment, confidence-sensitive assets behave in ways models do not predict well. Silver sits awkwardly in that category. It is industrial enough to be cyclical and monetary enough to be psychological. Add geopolitical fragmentation, supply chain reconfiguration, and the growing preference for resilience over efficiency, and you get a world where more inventory is held, not less. That inventory does not show up cleanly in futures positioning. So you end up with a situation where physical metal quietly moves from liquid pools into long-term storage, while paper markets continue to trade as if nothing has changed. For a while, both realities can coexist. Eventually, one has to acknowledge the other. The important point is not that the system is about to fail. It is that the framework most people use to interpret silver is incomplete. Price alone is not the whole signal. Availability, incentives, and behavior matter just as much, and those variables are quietly shifting. When you look back at previous periods where paper and physical silver markets drifted apart, the most important lesson is not what happened, but how it happened. The resolution was rarely clean, rarely immediate, and almost never obvious in real time. People tend to remember the outcome and forget the long stretch of uncertainty and confusion that came before it. In those historical moments, silver did not suddenly break. What changed was behavior. Small adjustments accumulated until old assumptions no longer worked smoothly. Delivery ratios edged higher. Premiums stayed elevated longer than expected. Liquidity thinned at the margins, not in dramatic fashion, but just enough to make participants more cautious. And in market systems, caution is often more powerful than fear. One of the indicators professionals quietly watch is not the absolute level of inventories, but the rate of change. Sharp drops can be reversed. Steady declines signal structural flow. Right now, some segments of the silver market appear to be experiencing the second pattern, although the data is fragmented and must be interpreted carefully. Another subtle signal lies in term structure. When near-term delivery becomes relatively more expensive than longer-dated exposure, it does not scream crisis. It whispers urgency. It tells you that some participants are willing to pay more for certainty, not because they are panicking, but because they are reprioritizing risk. That shift rarely shows up in the way retail investors expect, but it changes how stress is distributed across the system. What makes silver especially complex is that it does not resolve imbalances the way other commodities do. You cannot easily substitute it at scale. You cannot ramp supply quickly without long lead times. And you cannot rely indefinitely on above-ground stockpiles because much of that metal is already spoken for, either contractually or functionally. At the same time, silver has a long history of frustrating anyone who tries to force a narrative onto it. Periods of genuine tightness have been followed by long stretches of stagnation. Episodes of excitement have faded into years of sideways movement. That unpredictability is not a flaw. It is a feature of a market caught between competing roles. This is why framing matters. If you approach silver expecting a binary outcome, you are likely to miss what is actually happening. The more realistic scenario space is broader and less satisfying. Adjustments can occur through price, but they can also occur through participation. Fewer contracts traded, different hedging behavior, shifts in who holds risk and for how long. Another plausible outcome, if current conditions persist, is not a dramatic price surge, but a repricing of convenience. Physical silver could increasingly trade at a persistent premium to paper exposure, not as a temporary distortion, but as a semi-structural feature. That would challenge the assumption that futures prices are always the most relevant reference point. It would not mean futures markets are broken. It would mean their role has narrowed. There's also the question of regulation and transparency. Market structures evolve, sometimes in response to stress, sometimes preemptively. Reporting rules change, classification systems adjust, even small regulatory shifts can alter incentives in ways that ripple outward. None of this needs to be dramatic to matter. Geopolitically, silver sits in an uncomfortable position. It is essential enough to be widely used, but not strategic enough to be protected in a coordinated way. That makes it vulnerable to policy blind spots. Environmental regulations, energy constraints, trade restrictions, and permitting delays can all affect supply indirectly without ever mentioning silver by name. Then there is sentiment, which almost always lags reality. Most participants anchor to what has worked before. If silver has been range-bound for years, people assume it will remain so. That assumption becomes self-reinforcing until it quietly stops working. Disruption does not need to be loud. It only needs to be persistent enough to make old heuristics unreliable. What is notable about the current moment is not that everyone is worried. It is that almost no one is. Attention is elsewhere. Capital is chasing more fashionable stories. Silver is being treated as background noise. Historically, that is when structural changes have the most room to develop unnoticed. None of this guarantees an outcome. It does not predict timing. It does not even insist that the divergence we are seeing must resolve through price. It simply suggests that the market may be accumulating unresolved questions. And unresolved questions have a way of demanding attention eventually. If paper prices continue to lag physical signals, the gap between perception and reality widens. At some point, participants have to reconcile the two, either by reassessing availability or by reinterpreting price. Which path that takes depends on variables that are still in motion. The uncomfortable truth is that silver often moves when the fewest people are prepared for it, and it rarely moves in ways that satisfy anyone's expectations. That is not a prediction. It is an observation drawn from long, messy history. For now, what matters most is not conviction, but awareness. Understanding that calm surfaces can hide complex currents underneath. That markets do not need villains or secrets to behave strangely. They only need incentives that no longer align perfectly. The uncomfortable truth about markets is that they rarely change in the way people expect. They do not usually move because a single dramatic headline appears. They move because a set of quiet assumptions slowly stops working. By the time that becomes obvious, the adjustment is already underway. Silver, more than most assets, has a long history of behaving this way. It spends years being ignored, then months being debated, and occasionally weeks being misunderstood. What makes the current environment worth paying attention to is not that something has already broken, but that the structure is showing signs of strain while the surface still looks calm. That combination is where mispricings tend to form. If you are trying to think about silver rationally, the most important shift is not in price expectations, but in framework. The question is no longer simply whether silver will go up or down. The more relevant question is how resilient the system is to changes in behavior. How much flexibility really exists in supply? How much inventory is truly available versus theoretically available? And how quickly paper confidence can adapt if physical constraints become harder to ignore? Those are not questions that show up cleanly in charts. They show up in incentives, in lead times, in premiums, and in who is willing to commit capital for how long. One of the mistakes people consistently make is assuming that markets only reprice through price. In reality, markets often adjust through access. Something becomes harder to source before it becomes more expensive, or it becomes more expensive in specific contexts before the reference price changes. That is exactly what rising physical premiums relative to spot prices are quietly signaling. Not a crisis, but a shift in what people are willing to pay for certainty. Another mistake is thinking in binary outcomes. Either silver explodes or nothing happens. That is almost never how it works. More often, the system evolves. Liquidity becomes more selective, participation shifts, hedging behavior changes. Some actors become more cautious, while others become more committed. Those changes do not make headlines, but they alter the character of the market. If you are holding silver or thinking about it, the practical implication is not urgency, it is clarity. Understanding what you own and why you own it. Paper exposure and physical metal are not the same instrument, even if they are linked by a reference price. They behave differently under stress. They serve different purposes. Neither is inherently superior in all contexts, but confusing them leads to false confidence. Physical silver is not about trading. It is about optionality. It is about access in environments where access might matter more than price. Paper silver is about exposure, liquidity, and flexibility. It works best in environments where the system is functioning smoothly. The current signals suggest that the system is still functioning, but perhaps with a little more friction than before. That is not something to panic about. It is something to respect. Another important point is patience. Structural changes do not resolve on retail timelines. They resolve on industrial and institutional timelines. That can mean long periods of apparent inactivity followed by adjustments that feel sudden only because nobody was watching the slow buildup. Silver has a long history of doing exactly that. It frustrates both bulls and bears because it refuses to conform to simple narratives. If you're looking for a dramatic prediction, this is not it. There are too many moving parts, too many feedback loops, and too much uncertainty to justify that kind of confidence. What you can do is pay attention to the right signals. Watch premiums. Watch delivery behavior. Watch inventory trends, not just levels. Watch how participants talk about risk and availability, not just about price. Those are the places where shifts usually appear first. There's also a broader lesson here that goes beyond silver. We live in a financial system that has become increasingly abstract. Claims trade far more easily than things. That works extraordinarily well until occasionally the distinction between a claim and the thing itself starts to matter again. When that happens, markets do not break overnight. They adapt, sometimes awkwardly, sometimes slowly, sometimes expensively. Silver sits right on that fault line between abstraction and reality. That is why it behaves the way it does. And that is why it is so often misunderstood. The silver market today seems to be telling two stories at the same time. One of calm, continuity, and normality. And one of subtle tightening, quiet reprioritization, and growing attention to physical constraints. Those two stories can coexist for a long time. They always do. Until, at some point, they do not. Which one eventually dominates is not something anyone can know in advance. But you do not need certainty to be thoughtful. You only need to recognize that price is not the whole signal, and that the absence of drama is not the same thing as the absence of change. The real question the market seems to be asking right now is simple, but uncomfortable. In a world built on promises, how much does the presence of the thing itself still matter? That question does not demand an answer today, but history suggests it does not go unanswered forever.